Welcome to the MUFG Global Markets Podcast. I am your host, Ellen Tang, and today I am joined by Glenn Schultz, the head of agency mortgage prepayment modeling and strategy for MUFG. Today is Wednesday, February 8th, and Glenn, always nice to have you. Thank you for joining us again this month.
Oh, hi, Ellen. My pleasure. Thanks for inviting me again.
Of course. So as we always like to kick off these podcasts, we can talk about the remit data from the prior month. So the January remit data came out Monday, February 6th, and aggregate prepayment measured by the Fannie Mae 30-year MBS declined by a little over the 17% on a month-over-month basis, coming in around 3.7 CPR. And if we're looking at the Fannie Mae 15-year prepayment speeds, that declined a little over 9% on a month-over-month basis, down to about 5 CPR. So this month's speed print is very low. In fact, probably the lowest since mid-1980s. You published a client asking the question, how low can turnover get? Can you elaborate on that?
Yeah, so since January's remittance data reflects kind of the lowest seasonal factors, right? The January seasonals, as well as the mid-October to November 7.25 peak in the 30-year mortgage rate. So that's kind of just looking at the lagged effect of rates on origination and prepayments and things like that. Then December 2000 was the last time the 30-year rate was above 7%. So that's quite a while ago. That's 22 years ago. And I think many would-be buyers, in particular the new buyers, right, are conditioned to think of the 30-year mortgage rate in the 5% or below range. And the thinking is, for the most part, a 5% mortgage rate is a high mortgage rate because the long-term average since 2000 is well below, sort of 5%. So the absolute level of the 30-year mortgage rate looked very expensive financing in terms of would-be buyers. In addition, there's some concern with respect to potential home declines as well. So we kind of had this high mortgage rate, talk of home price declines, recession, those types of things coming into the equation at the very same time that we hit these really low January seasonal factors.
I see. So your argument is that potential buyers have stepped away from the housing market based on the perception of expensive, quote unquote, financing and the potential for the declining home prices amid a recession.
Right. Yeah, there is, at least this is my opinion, right? So there's this myth, right? I assume it started around the housing collapse or about that time, say 2008, 2010, that when the mortgage rate goes up, home prices must go down, right? So that's really to say that residential housing prices behave like long duration financial risk assets, and that the price response function is immediate, like say the 30-year treasury, right? So interest rates go up, prices go down, that type of thing. This line of thinking leads to, I think, very faulty reasoning with respect to the housing market and home prices. For example, I just read an article the other day in which the interviewee stated, if the 30-year mortgage rate goes up from 3 to 6, then home prices must fall 30% in order for affordability to remain constant. That was the quote, right? But this line of thinking really is nonsense, as it implies that home prices must have the same volatility of interest rates. It also implies that home prices have an effective duration of about equivalent to the 10-year or a little bit less. And then it kind of goes on to extrapolate that, right? So in terms of financial risk assets, you would think, do home prices have the same liquidity as these types of assets? And the answer to that is no. And so what happens is there's been this tendency, I think, to hold constant income, affordability, all these things around home prices, right? And then allow interest rates to move up and down, and then say home prices must, move like risk financial assets. And I think to a degree that's nonsense.
Got it. So it sounds like you're arguing a little bit that the mortgage rate shock and its impact on home prices is overstated.
Right. Yeah, exactly. And that runs directly into the home price question, right? That overstatement on that. So would-be buyers would step away from the market in anticipation of price declines that would in turn restore affordability. And that's just not the driver I think, of home prices. Obviously, it's one driver, but it's not a principal driver. Because what happens is that home prices fall, then sellers will step away from the market as they're reluctant to list into a declining price environment, especially if they don't necessarily have to. In other words, they're not a forced or distressed seller. So as a result, existing home sales fall, and by extension, then turnover falls as well. So this is a phenomenon that we've seen sort of play out over the last 3 or 4 months. And again, like I said, we butt right into these like super low January seasonal factors. We end up with a 3.7 CPR, which is probably the lowest that we've seen in terms of aggregate prepayment since the mid 1980s.
Yeah, understood. So one thing you haven't mentioned yet is sort of the lock-in effect and its influence on prepayments. Can we talk a little bit about that?
Yeah, the lock-in effect, right? That was first identified in the mid 1990s by the prepayment modeling team at Prudential Securities. So I actually worked there at the time. So we were all very excited about the identification of the lock-in effect, and people have talked about it since, and it's become, sort of part of everybody's prepayment model, and it's really become what I consider to be part of the prepayment modeling lore, right? And so this sort of happened, in the mid 1990s, as I said, when we hit this first intergenerational low in the 30-year mortgage rate, which had followed a pretty significant refinance wave. But, one has to really note that occurred on the heels of the savings and loan bailout and the recession in the early 1990s. Home prices were very anemic during that period of time, and the housing market was actually quite anemic at that time as well. So really, you're kind of looking at the lock-in effect at the time that it was identified may have really been convoluted with, some macro housing sort of fundamentals, and as a result, maybe somewhat overstated, as I said, in the prepayment modeling lore, which is kind of the point of my recent client note that we put out this morning. So that's not to say that it doesn't exist, only that it may not be as strong or as persistent as many believe.
Understood, Glenn. So the client note, you discuss this and outlines the characteristics of new production discount pools. So first, seasonal influences are less on new production discount pools relative to other moderate or seasoned pools. And the second point is new production discount pools exhibit an elongation of the seasoning ramp, resulting in relatively low initial prepayment versus, say, the more aggressive seasoning ramps the market has become accustomed to. So if this is the case and lock-in effect is overstated in prepayment models, then discount coupons are then undervalued?
Right. Yeah. I mean, that's my point, right? So with respect to the discount coupons, that whole cohort there, the new production, a small prepayment delta has a big impact on the value of these new production coupons. So again, just to quickly review, new production is defined as sort of 30 walla and less, right? So this does produce kind of what I consider to be a free optionality, if you will, right? That's brought about by the undervaluation of the principal only or PO nature of the discounts. And so, whenever you get a free option or something looks like a free option, you're probably supposed to take that, right? And so the question I really have is, that if we're looking at this, 2, 3, 4 long-term CPRs that some models are putting out, then the discounts are undervalued because we still, I think, look at a long-term sort of CPR that's more like an 8 or 10 type of number, not a 4 number.
So at the end of the day, the lock-in effect and valuation of the discount coupon is dependent on the view with respect to existing home sales, and then I suppose home price appreciation. What is your personal view on each?
Mm-hmm. Right, exactly. It always is going to come back to that, right? So with respect to existing home sales, we're forecasting a summer peak between 475,000 and 500,000 units. That would be like a monthly number for June, right? So annualizing that and then considering single family detached housing stock, which is about 83 million units, we get, kind of a 7% turnover rate for for the summer months, right? For the peak summer months. So it's a little bit below kind of the 8% turnover rate that most models would say is kind of the national housing. But it's above that, which is implied by kind of the lock-in effect, right? So then with respect to home prices, again, the long-term trend is in favor of continued home price appreciation, right? So currently, the U.S. is facing a housing shortage of about 10 million units, and it's unlikely that we're going to fill, a 10,000 unit housing gap anytime in the near or the immediate future. So there's a shortage component here that puts, I believe, a floor on sort of home prices and actually, lifts them or gives some lift to home price appreciation, provided that we don't, end up in the same situation we ended up, following the financial crisis, where we had, hundreds and hundreds of thousands of distressed homes all coming onto the market at the same time, and those types of things. So I really think that the fundamentals of the housing market are really sort of in favor of home price appreciation going forward, in a 2 to 5% area, and existing home sales still probably running around, an 8 to 10% turnover rate. So it's really this elongation of the seasoning ramp that we're dealing with right now in low seasonal factors.
So today's client challenges the conventional wisdom with respect to the strength and nature of the lock-in effect, and argues for mortgage investors to take a hard look at valuations in the discount sectors. Thanks so much, Glenn, for joining us again. And thank you for listening to the MUFG Global Markets Podcast. Feel free to rate, review, and subscribe on Apple, Spotify, or wherever you can get your podcast. And please reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets Research team.